I wanted to thank everyone for joining. Welcome. Before we get started, just a few housekeeping items. I did mute everyone upon entrance, but don't hesitate to unmute yourself if you have a question. As you can see, the Zoom is set up as a meeting as opposed to a webinar. So we want to facilitate a conversation with our presenters and answer all of your questions as we go along, right? So if you do have a question, feel free to, it's under the response button on your Zoom panel. You can raise your hand or just type it in the chat. CPE credits will be issued to all those that participate in the polling questions. Polling is done a little bit different through a third-party software, so it'll be fun. You'll see live results on the screen. All of the slide deck and information and contacts for the individuals today will be distributed after the meeting. And with that, I'm going to do a quick introduction on CashVest by 3+1. What they do is they harness liquidity data resources to maximize the value of every single dollar through the power of liquidity analysis. So it's a breakdown of how cash can be utilized for current and future operating needs, offsetting banking fees, borrowing, and earnings opportunities. The finance officials of public agencies, higher education institutions, and hospitals can execute cash, operating, and investment management decisions with more confidence and greater ease through this program. So joining us today are a few members from the 3+1 team, as well as Kyle Klein, National Director of Strategic Partnerships from the National Association of Counties Financial Services Corporation. And my name is Chase Brofman. I'm a Member Services Associate from the California State Association of Counties Finance Corporation. That was a mouthful. The CSAC Finance Corporation, we're really excited to announce the brand new partnership with 3+1 and roll out their new CashVest program to all California public agencies. So with that, I'll go ahead and hand it over to Garrett McDonald. He's going to introduce his 3+1 team and then begin his presentation.
Thank you very much, Chase, and good morning, everyone. Thank you for joining us. I'm Garrett McDonald, and I'm joined by my colleague, Tyler Frame, also. And we're so appreciative of you taking some valuable time out of your day to really learn how to leverage and maximize the value on public dollars amid COVID-19. We'd like to thank CSAC Finance Corporation, Chase, Laura, everything your organization does, and for the opportunity today to share with you. We really appreciate the work that you do for your communities around the state. We're really not going to be long today, but before we get started, we'd like to thank, again, the National Association of Counties for their partnership with CashVest by 3+1. 3+1 is endorsed and has a partnership with NACO, and our work together has led to over $350 million being brought back to public entities nationwide. It's amazing. The number keeps growing every single day, but that's why we love what we do, because we get to bring new resources to entities. There aren't a lot of solutions that bring and add resources to budgets. There's a lot that take away resources. And today we're going to go through some opportunities to show you how to add resources to your bottom line, and even how to show your constituents, your taxpayers, your peers, how to use liquidity data, how to use liquidity to maximize the value on all taxpayer cash. Really being able to share with your taxpayers that you're exceeding benchmarks and expectations on your liquidity performance is vital. And today it's really tough, right? Because of the scenario that we're in. 3+1, just to give you a brief, really quick overview, we're a fintech data provider. We help entities all over the country, including in California, with their cash and liquidity management functions. We serve counties nationwide, and today we're going to really share some of our tips and some of our data with you. We want this to be a conversation. So as Chase said, don't be afraid to submit a question or to raise your hand, figuratively speaking. But it's tough to get a clear picture of county finances amid a pandemic like we're in. And it's important to know that we're not a bank. We don't invest money. We're not an investment advisor. We're not registered. We're not a broker dealer. We're just a fintech provider looking to bring resources to help you really maximize the value on all of your taxpayer dollars. So here's a brief overview of some of the learning objectives today. Knowing the difference between liquidity and cash flow, right? Every entity does a cash flow forecast, a cash flow analysis. but is it really being used to help you get a clear picture of your entity's liquidity position? And those are two different aspects of cash. Your cash flow forecast might tell you one thing, and oftentimes your liquidity tells you something different. We have examples of that today. How to use liquidity data to identify all available cash to your entity and how long it's available, right? Do you use a worst case liquidity forecast? If not, you may be missing a big planning tool that can help you positively impact your budget planning process. Before COVID-19, a lot of entities, when we were working on worst case liquidity forecasts, said, you know what, that's just not something we're going to focus on. We're going to focus on our forecast, our cash flow. But looking at liquidity has increasingly come a lot more important and worst case scenarios to be able to plan effectively and budget effectively. How a future liquidity forecast in conjunction with cash flow forecasts can help you prepare your entity for upcoming cash needs, right? Really vital. And knowing what your cash needs are at a future point in time so that it allows you to maximize the value of cash maybe you don't need today, using stress testing and peer benchmarking data. So before we get started, as Chase said, we're going to use a polling feature, and we really want you to get involved so that you can earn some CPE credits. So typically, it's kind of encouraged to take your phones out and maybe put them away, but today we want to encourage you to take them out. And if you go to your browser on your phone, and I'm going to do it right along with you, and you follow the directions on the screen, and visit pollev.com/3, the number 3, the word plus, and the number 1. It's going to bring you to a page where it's going to ask you for your name. And that's how we're going to be able to tell who was involved in the polling so you can get CPE credits. And we're not going to share this information or post it anywhere. It's all anonymous. But this way you can earn CPE credits and get involved in some of the polling questions today. So we like to just do a test polling question to make sure that it's working. So if you can please answer the polling question and you'll see the responses pop up on the screen, that would be great. So the first question is, I like live polling. Some of you say, no, I don't. But most of you, thank goodness, say you do.
Luckily, that was me. I just, I wanted to test it out. It's working great.
Thank you very much. So luckily, we're not going to have a ton of polling questions, but we're going to have a few to get everyone involved today. So I hope that's working. Again, pollev.com/the number 3, the word plus, and the number 1. And as we go through the questions, you may see it pop up on the screen first, but then you'll see it corresponding on your phone. Today, it's really important to know that the marketplace has evolved, right? We're going to provide you with some tools and solutions on how to make it through some of these difficult times. And it's important to understand where we are and where we're going in the public banking and liquidity marketplace. We don't have to tell you that COVID-19 has been the largest disruption to local government finance ever. But what you may not know is that these implications not only impact your liquidity levels internally, but they also impact how your financial partners view you, how your rating agencies view you, how your banks, and even your state's local government fiscal accountability office or comptroller or chief auditor. Before the pandemic, really counties specifically, compared to other local governments, tended to have lower cash ratios and cash as a percentage of expenditures. And this really may explain why 54% of counties showed evidence of cash flow problems. Again, I'll say that and repeat that. According to the U.S. Government Accountability Office, 54% of counties showed evidence of cash flow problems. So you're not alone if you're there. If you're not there, you can still use liquidity to bring even more value to your constituents, your taxpayers. But if you are, you're not alone. And that's been exacerbated with COVID-19. Fitch Ratings recently released an article saying that liquidity is becoming a much larger part of how they look at rating agency or rating local governments. Specifically, Fitch said, cash management tools are not typically the focus of Fitch's analysis of US local governments, as liquidity is sufficient for operating needs for nearly all issuers through cyclical downturns. However, they said, given the uncertain nature of the coronavirus pandemic and the depth and duration of its impact on the economy, Fitch believes many local governments may explore extraordinary cash flow support measures in the near term. Now, these cash flow support measures may include borrowings, asset sales, et cetera, but today we're going to talk about how a known cash management support tool that is getting a lot of attention and helping counties across the country, and it can help yours also. It's worth saying also the Municipal Securities Rulemaking Board in a recent publication said ratings of liquidity is a determinant of the outcome of a credit rating. A higher credit rating, obviously, or more comfortability on your entity's ability to pay debt obligations brings significant benefit to your counties and savings. So these are some of the areas that liquidity and cash management is really coming more into focus. But first, we need to examine the difference between cash flow and liquidity. And again, we're not going to be long, and it kind of builds the framework about what we're going to talk about today. But when a bank takes on deposits from a local government, and we're talking about the difference between cash flow and liquidity, that deposit is a liability on the bank's balance sheet until it's loaned out, right? They owe that to you. It's the county's asset and it's the bank's liability because it owes the government its deposit back. If it loans the cash out, it becomes the bank's asset because some other party owes the bank the principal plus the interest, which the bank uses to earn revenue. How does the bank understand how long the government deposit will be on its books in order to feel comfortable loaning money out? Well, the answer is liquidity data. Looking at it from a county's perspective, when an entity cuts a check, in effect, from your general ledger perspective, that money may be gone, but it hasn't cleared the bank yet, meaning the bank's still collateralizing those funds. You might not be earning on those funds. They may be used to cover banking fees, maybe not. But this is an example of the difference between cash flow and liquidity. Liquidity puts a defined time horizon on every dollar that you have on deposit. From the moment that you take $1 in to the moment you spend that dollar, how long do you have it? What can you do with it? And how can you bring value back to the local government? This is really the difference between cash flow, which is finance, budget, planning exercise, and liquidity, which is a treasury picture, right? You have finance planning for the future, you have accounting, reconciling the past, but the treasury, the today picture, is the liquidity picture. Now, you may be asking, Garrett, what good is it really at looking at liquidity? It's not going to provide my county with many interest rates because interest rates are low, or it's not going to do much for me. Well, let us tell you today that just as Fitch Ratings said, liquidity isn't about rates. That wasn't in their description. It's nice, it's an add-on. But today, in this world where data is becoming so much more paramount, it's important, and we feel as a data provider, that these data opportunities, these new data opportunities are available to you all, and that you have as much information on your liquidity position as possible. So although rates are an offshoot of what can come with exceptional liquidity management, we all know that really rating agencies don't score us based on higher interest earnings. Your rating agency scores you based on your county's capacity really to understand your liquidity needs and manage them and pay the obligations. The evidence that you do it well, it being liquidity management, comes when you're able to show your constituents that without any additional effort, because you understand your entity's, your county's liquidity position, that you're going to be able to do spending, planning, higher credit rating, lower interest rates for your debt obligations, and that you've also maximized the value on your cash. We can tell you today that there are entities large and small. We work with entities that have a budget as small as $5 million a year to entities that have a budget in the multiple billions. And in each case, it's a powerful message to show that the return on investment for the cash, for the liquidity, is bringing new resources for your entity. And that's what we're going to talk about today, some of these data resources. So at this time, I'm going to introduce my colleague again, Tyler Frame, who's going to show you some benefits of looking at cash, the positive net impacts of the flow of cash and liquidity in a different way to allow you to bring new resources and new ways to earn and save for your liquidity. Tyler?
Thanks, Garrett. Really appreciate your time today, everyone. Garrett makes a great point. You know, everyone is so focused on, do we have enough cash to sustain operations today? Because in a global pandemic, we're obviously experiencing a lot of different stressors, but fortunately, we're also in the midst of a new data revolution. There are so many new technology data tools that can help you manage liquidity so that you can focus on the safety of your constituents and other challenges that may have been brought upon you due to this pandemic. And one of those tools is looking at that net liquidity impact on your entity. For example, in this table here, you can see that an entity over the last 12 months has wildly different net impacts on the actual cash it has available and what it needs to sustain its operations. Just looking back between August 2020, which is that second to last row on the table, you can see that the county was bringing in about $40.8 million, but it also had to spend $52 million. So what does that mean? Well, it means the county's going to need about $11.1 million in a net difference to sustain its operations. Conversely, going forward to September of 2020, it's a totally different picture because the county's bringing in about $37 million, but only spending about $10.1 million. From a cash flow perspective, you may only be looking at those negative flows and saying, oh my gosh, we need $10 million. But if you're not considering what you have already and what's coming in the door, there's a lot of different opportunity, especially when your overall cash position is increasing for a particular month of the year.
That's right. And so looking at your positive flows in addition to your negative flows, and this is looking at every transaction, every flow that has that's going through every bank account that you may have. Some entities work with 2 banks. We work with entities that have as many as 15 different banks. Looking at the flows and getting a picture holistically on what that means from a 30,000-foot view perspective helps you identify, as you see on the page in front of you, what are our longer term dollars? So many entities say, you know what? I know maybe what we have for the next week, the next 2 weeks. One of our colleagues, Bill Cherry, who was a treasurer for 24 years, affectionately says, listen, before CashVest, before looking at liquidity, I would literally write out on a piece of paper what payroll was, what the check run was, what I would need, maybe what the pension payment was during certain times. And I would make a determination about what I could do. But with liquidity data, I realized I had left a lot of opportunity on the table that allows me then to add that much more resources. And in this period, adding additional resources or savings is so important. So you'll see on your screen right now, the multicolored area is really the strategic liquidity. Now, we tried to pick a size entity that was kind of mid, not too large, not in the billions of dollars, but not too small. But the principles of cash management are the same no matter if you're big or you're small. But looking at the longer flows of cash, How long do we have it for? Do we have it for between 24 and 30 months? That may not mean we're going to invest it for that long. But if we have it for that long, it allows us to share this information with our financial providers. It allows us to look at this information internally and identify, are we maximizing the value of our financial resources? In addition, the money that you see in gray are your working capital dollars or your operating dollars. And so that's really the cash flow perspective. But you'll notice on the graph that you see, that's still approximately $49 million. So this entity may be saying, listen, I need to keep $49 million on deposit in order for me to operate, even if I feel comfortable with my strategic liquidity and putting it to work. Well, the answer is, how do we look at that working capital or operating cash in a strategic way today so that in the future, we know what our cash position is going to be? So what you see on your screen right now is a forward looking. If I go back, you'll notice this is looking historically at cash. But this is looking forward. And these are stress tests and simulations based on a statistical confidence interval on where your cash is going to be in the future. So you may say, listen, Garrett, Tyler, that's not really what we do right now, but is this a way to help you look at cash more strategically so you can say, looking into the future, on March 25th of 2021, in a worst case scenario, my cash is going to be here. And how powerful of a message that is to share with boards and with finance offices, budget planning, just all around for governments to be able to say, listen, what you see on your screen now in orange is a worst case scenario. What you see in blue is the actual forecast results. And what you see in yellow is the prior year actuals. Being able to compare the worst case forecast results, which again, before coronavirus came along, we might have said was too drastic, but with it examines, if revenues fall off of a cliff, where are we going to be? And what do we need to do, maybe in terms of borrowing? What do we need to do to plan? You'll notice in this case, on this particular graph, this is pooled cash accounts only. So, governments obviously have many different funds. And so this was just looking at the general fund pooled cash accounts only. And this overall forward forecast looking into the future is based on an objective third party knowing, based on where we have been and other data is being collected by governments, where could we be and how could that impact our overall liquidity picture? Tyler?
I think we can all agree that, at the beginning of this pandemic, we just didn't know where we were going to be. And having data and information at your fingertips to get an idea of where we're going can be really valuable, because then we know in an absolute worst case scenario, no cash coming in the door, how much time do we have? When do we maybe need to start looking at some other funding sources, liquidating investments a little bit early, or just preparing for that worst case scenario in the future? That's really valuable, especially at a time right now.
Yeah. When you're talking about cash flow, what you're seeing on your screen right now is a great example of that. Looking at cash receipts, total available cash, total cash disbursements, and then what the net impact of that is. And so you do that on a projected basis every single month. And there may be a month that you find, like in this case, October, where you have almost a $32 million cash flow need. So how does that compare to liquidity? Well, in this example here, looking at the same entity, that October cash need was not what the liquidity picture showed. The same entity, one cash flow picture showing that, hey, we have a $32 million need. The liquidity picture showed we have almost $500 million on deposit. So that's the difference between cash flow and liquidity. Now, what can we do with that is really what adds those additional resources, and looking at the return on investment, not the return on investment that we're so used to hearing, but taking into consideration your banking fees, right? How much your compensating balances are, how much do you have to keep on deposit in order to pay for your banking fees? If you have to keep a significant amount on deposit, or it's going up because compensating balances have been going up as earnings credit rates go down, what's the opportunity cost on that? If you're having to keep 40, 50, 60, 70, 80 million and it keeps going up, maybe it's time to look at what the benchmarks say, right? Do you have that benchmark data to be able to assess, am I performing at the highest level that I possibly can perform? In this case, as of October, this entity's return on investment, looking at banking fees, looking at the interest earnings, looking at what the opportunity cost was, the real return on investment was 27 basis points at a time when the effective Fed funds rate was 0.08%. So if you know that you have cash available on a daily basis that you can put towards a state pool that's earning more value than what the bank is providing, because see, an effective low interest rates and the environment that we've been in for banks is effectively charging entities to keep money on deposit. And so if you can at least have it somewhere where it's not taking value away and it's not going to cost you money, that is actually a value generating tool. But then knowing if I've got cash available between 6 months to 12 months, can I push that over and earn a little bit more in a longer term pool? Or are there fixed income opportunities available to me that can add those resources that I desperately need? So this leads us to our other polling question. Data is a key complement of your investment decisions. So if you want to answer this question, what happens a lot of times is when we talk to entities, they say, you know what, I use cash flow, I like cash flow, but I'm really not using data to the level that I could be in order to get the outcome that we would like to get. And you're not alone, and that happens. And so how can we look at data to provide opportunities to maximize the value of every dollar? It's worth it to be able to say, hey, we are doing everything we can to maximize the value on every dollar we have. So for the people that said, you know what, I'm not using it to the level that I could be, that's okay. These are new opportunities, and we hope that we're giving you some learning keys and education on how to maybe take some tips. If you take one thing away that can help, that's a great success. And we'd love to help you. For those entities that say, hey, data is a key component, it is a key complement to how I do things, then that's great. Can we take it to the next level? Can we do more? Can we add more to our taxpayers for resources? And so one of those ways that we can do that is looking at different RFPs. And so what we find today is that the banking dynamic has changed so significantly that looking at benchmark data becomes even that much more important. And so this is an entity that Tyler's going to take you through some of the different results. Now, it was a rather large entity, about a $341 million a year annual budget. But looking at their banking fees, looking at how much they kept on deposit historically, which in this case, as you'll see on line 19, was about 5.9 million. So a $341 million annual budget, but only keeping about 5.8 or $9 million on deposit. That's amazing. How are they doing that? By looking at liquidity data. Tyler, can you take us in and show us some of this information on how this entity was able to increase performance and maximize the value that they received from their banking providers?
Absolutely. Right now, you're probably not hearing from your banks quite as much as you used to, but it's surprising to see what the different range of opportunities is available still in the marketplace. just looking at these 3 banks that responded to a county's RFP, you can see the results are vastly different. In one scenario, annual fees are about $15,000 a year. In another, they're about $64,000 a year. Now, this is looking at the same level of servicing. So it's not one bank has vastly different capabilities than another. They just are in different positions to provide different value to this particular county. And I think it's important to make the distinction here that it's not just about what the overall fee structure is that the bank's offering, but more importantly, how much would this entity need to keep on deposit to offset its fees? And you can see based on the different variables here in the table, anywhere from about $6 million to offset the fees up to about $25.5 million. So what does that mean from a county's perspective? Well, if you can only keep $6 million on deposit and offset all your banking fees, that's a lot of available cash that you have between 6 and 25 million that you can go out in the marketplace, harness the time horizon of your funds, and earn additional value. Whereas if you're having to keep $25.5 million on deposit to offset your fees, that really limits the opportunity that you have.
That's correct, Tyler. And this entity said, you know what? We want to really maximize the value on our dollars. We want to know what our daily dollars are that we can put in a daily available pool, but we also want to know how we can utilize other pools, maybe medium-term pools, and then what we can put in CDs and other fixed income opportunities. So a couple things that we just wanted to point out, and I just made a note in the chat box, but if you have a question on these results or something you want to ask, this, by the way, is recent. We are still working to finalize this. So this is hot off the press. This isn't something that's old. This is from the end of last month. And we wanted to put this in here to show you some benchmark data, to show you some recent results. Bank One said, listen, we aren't going to have an earnings credit rate. We are going to require basically that you keep $6 million on deposit, which is a little bit more than their historical balances are. And that's it. Now, of course, there's an opportunity cost on that $6 million if you can't earn anything on it, which is where the $15,000 comes from. Bank Two said, we have an earnings credit rate, okay, but they had FDIC fees, which lowered the effective earnings credit rate. Just as an offshoot of deviation a little bit, looking at your analysis statements and aggregating that data is imperative, because so much is changing in the marketplace right now. And banks aren't necessarily, we love banks and we're bank agnostic. We work with a lot of different banks, big, small. You have to have a bank. You have to have a great relationship with a bank. And we are big proponents of that. But we serve you. We work for you. You are our stakeholders. When you have great results, then you are happy. And banks serve different stakeholders. They're shareholders, and that's okay. But how can we use data to maximize the value that you're receiving from your banks and get a more equitable relationship? In this case, this entity said, listen, the effective earnings credit rate that we're going to offer is 25 basis points that you see on line 18. Because after you take those fees out, it really lowers the effective earnings credit rate and increases the amount you have to keep on deposit. But in this case also, you'll see that they're adding 15 basis points in a money market rate to earn on monies. And then Bank Three, where you have fees at $64,000, and you may say, listen, I don't pay fees. And we understand that, because if you keep enough cash on deposit, they're not going to debit you fees, but it's an opportunity cost if you can earn at least the effective federal funds rate right now. And it won't cost you money to keep dollars on deposit. This bank said, listen, we're only going to pay 3 basis points, right, in interest, and our effective earnings credit rate is going to be 25 basis points. So the difference between what's required to keep on deposit in order not to have fees is seen on line 25. First bank is $6 million. second bank is 14.7, and the third bank is 25.5. And the hard fees associated with this entity keeping the historical level of dollars that they had on deposit, which is what they wanted. They said, we don't want to keep more than we were, means their hard fees are going to be drastically different by each bank. So if they could earn 25 basis points looking at line 15 in bank one on 6 million, then they're effectively paying $15,000. For bank two, if they're having to keep 14.7 and they can earn interest over that, then they're effectively paying 22. And same thing with the third bank at 49. Here's the kicker on this. Each bank, although they provide the same level of servicing, would like different types of services. And so as we use our RFP prep platform to issue a digital RFP for county governments through our platform that takes away that reams of paper and analysis that you have to spend time reading. I always tell entities, if you really want to sleep well at night, just read some bank analysis statements before you go to bed, and that will put you right to sleep. How many of you know that's the truth? Same thing goes for these RFP results. But if you can do it digitally and have a system that automatically calculates what you're going to earn in hard fees, what the fees are, so that no bank can escape what you're going to have to pay, that really provides a very, very effective way to assess how you're going to get the most value for your banking relationship. So 3 quick pointers here. One, you got to monitor these things, right? It's difficult and it's possible to do it internally. We help with that. We monitor every single fee that you pay for, every line item, every AFP code. It matters because if you can identify how to reduce some of those costs, and by the way, benchmark it to what other peers are paying nationally, just imagine the power that you have on that. Why should you be paying more than someone else? And if you are, what's the justification? And how can RFP prep help you with that? So know the benchmarks, right? And understand your account structure on how overall it works to your treasury operation. So this goes to our next poll question. I'm comfortable with my banking arrangement today. I'm comfortable with my banking arrangement today. If you answer yes to this question, certainly, it's a congratulatory thing, because what a lot of entities that we work with say is, listen, I'm not unhappy, but I know I could do better. And we're going 1,000 miles an hour in 1,000 different directions. And I just simply don't have the time. Treasurers, finance directors, auditors are telling us to look into this. So today it's 50-50. 50% say, I'm comfortable. The other 50% say, I'm not comfortable. And in both cases, it's saying, hey, how can we identify if we can do better? And our stance is, if you can do better, it really doesn't hurt to find out what can we do differently to maximize the value on all of our financial resources. Peer benchmarks, Tyler, are important because, as you'll see on the screen, Tyler, when you look at the results, it's a lot different what a bank is willing to pay on $1 million CD.
Absolutely. It's hard to know what different banks' appetites are in different areas of the country, and understanding what your cash is worth from a liquidity perspective, and then matching that with opportunities that banks are providing to you is really important. And that's where we come in. We're the data providers. We're the ones looking out in the marketplace, scouring information to figure out what is an appropriate benchmark rate for your entity. You may be a county with $5 million available for 6 to 12 months or even 24 months. How does that compare to a county 100 miles away that's got similar cash positions and working with maybe similar banks? So understanding what the benchmarks are from a market perspective, but also a peer perspective, is really important to maximize the value of all of your financial resources.
You're 100% right. And by the way, I love the questions and comments. Some of you are sending a direct message to me, and I'm going to try to get to them all, but I love them, so keep them coming in, and I'll try to get to all of them. If you're issuing a bank RFP this year, I would really encourage you to just be open to a conversation. Allow us to share some of the data points that we are seeing so that you can get the full benefit of an RFP for your entity. A lot of times, banking RFPs may be an exercise that we have to go through. In Texas, for example, you have to issue an operating banking RFP every so often. It's required. So that's something that if you can really use a portal, a platform to allow you to just cut through everything and find out what the best pricing, the best rates, the best servicing, that is going to make a big difference. And we don't take banking RFPs lightly. Listen, it's a lot of work, okay? It's a lot of work, but having someone there to help you walk through the process makes it so much easier. And it adds a tremendous amount of value, okay? The entity that we showed you the results for is gonna add over $100,000 a year in value. That's significant. So as Tyler mentioned, entities say to us, listen, the effective federal funds rate is low. I'm paying attention to the market. Now the yield curve is steepening today, right? So the longer money's out for, the more interest you're getting, and the shorter it's out for, the smaller interest that you're getting. That was not the case in midst of the heart of the coronavirus pandemic, but it seems that the yield curve is normalizing a little bit. But in this case, you'll see that 7 different banks, many different rates, going from 10 all the way up to 40 basis points. The key is, do I really have $1 million for a year? Or do I have 2? Or do I have 500? Or do I have 100 million? And what can I do with it? And how is that impacting overall? This benchmark data is something that we provide our clients at least on a quarterly basis, some on a monthly basis, so that they know they're doing everything that they can. And by the way, again, effectively, if you're keeping money on deposit at the bank and think that just because the state pool isn't paying what it was 12 months ago, there's a real opportunity cost there. We want to provide data and help you through that. And some of the transaction data that we did talk about today will help you through that. So what are the impacts? And we're only going to be a couple more minutes. We like 45-minute webinars. So what are the impacts? This entity, you'll see, by the way, this is, we've pretty much shown 2 different entities. The large entity was an entity that had over $1 billion budget. This is the same entity that we talked about in the beginning on the forecasting and the historical time horizon data. This entity you'll see, and this is as of September, so we're through the thick of the coronavirus pandemic when rates went down and a lot of things were changing in the financial marketplace, had worked with us for a while, and it overlaps the liquidity levels that we saw earlier in the presentation. You'll see in this picture here, the black lines that run horizontally show the different liquidity levels of cash that this entity has and for how long they have it for. And what you see in purple is the fixed income, is the hedging against interest rate volatility. Interest rates go up, they go down. That's something that will happen continually. It's happened for 100 years. But in times when you can take advantage of it, are we doing that? And this entity is still earning, as of September, over 2.5%. That's significant because this entity also had decreased sales tax come in, and so it made up the difference. This is where that budget resource comes into play, where if you're always maximizing and looking at data in an effective manner, then it's, hey, this is adding a big resource. But the high yield liquid is that money that they may have between 30 days and 6 months, maybe less, maybe daily in 30 days that they have to keep liquid that they can continually earn on. And then the no to low yield is minimized so that every dollar is adding significant benefit. This is something that a lot of entities see, and it really does add a lot of value. So our question next is, I'm comfortable that I know exactly what the marketplace says my cash is worth. It's an important question because, typically we are seeing right now a lot of banks going silent. Again, we love banks, pro bank, pro financial provider, but sometimes having that third party be able to substantiate and give you the grounding that you are getting the best that you can means so much, and it's something that you all deserve. I can't tell you how much right now public finance professionals mean to us. We're friends with a lot of them. We work with a lot of them. We serve them. It's a tough position, a tough job, and being able to add another resource really helps you to say to your boards, to your constituents, to your office, hey, look, here's something that adds to our budget that's going to save us money, increase value, that we always will know that we're getting the most we can for our taxpayer dollars. So it's really important to be able to show, hey, what's the market like? What are our peers earning, not just in our state, but maybe our county? Maybe also what our peers are earning nationally. It's important. It's really important to know. So thank you. 89% say, I'm not comfortable that I know exactly what my cash is worth. Knowing what it's worth is directly connected to the time horizon of data. Directly connected to that. So benefits of managing liquidity, not cash flow, but liquidity. Just to sum up today for the last minute is boost your credit rating. It allows you to forecast future cash and debt needs. It allows you to identify cash as a revenue generating resource. So maybe that your office of your state comptroller or your government accountability office for finance, you can prove to them, hey, look, we're doing everything that we need to. Monitor your bank fees, but also have peace of mind. The last thing that we'll say today is these cash management audits are something that we're starting to see nationwide. What you see on your screen today is an example of a cash management audit in New York, but we see them in other states that we work in, that looks at an entity and says, hey, are you maximizing the value on all of your tax dollars? In this case, the findings said they didn't develop and manage a program for their investments. They didn't have a formal program. It says, they weren't seeking competitive rates, didn't have the programs in place to seek competitive rates out, and said, listen, this entity could have earned this, but they only earned this. And we're seeing this pop up more and more. And it's one of the reasons why, we're really starting to work with a lot more entities, and entities are using these tips to look at cash for themselves. But one thing we wanted to ask you all today is cash management a major focus of our audit, of your audit? Is it a major focus of audits or no? Because historically, it's not something that we have seen, but it seems that it's a more prevalent part of audits. And in that case, how we look at this differently can bring a tremendous amount of value. So yeah, this goes in line with what we've seen nationally, that they're saying, no, it's not a major focus, but it's amazing to us as we see pop up in each state that, especially at the state level, as they audit different entities, that this is something that they are looking at because resources are slim and they're trying to find out how can we do everything that we need to add resources. Again, I'm Garrett, and my colleague Tyler Frame joined us today, and we really appreciate the time. Thank you so much for giving us the opportunity to talk to you today. We have many different opportunities to provide value and resources to your budgets. CashVest through our liquidity monitoring, through our bank fee check service. Let's get a checkup. I need to go to the doctor and get a checkup. It's knowing, hey, what can we do? Can we do anything better? And there's value in knowing if you can or if you can't. And then RFP Prep, our full platform for issuing banking services, investment management services, RFPs, to make sure getting the best price, getting the best rate, that it's an easy process for you, that it's not onerous, that it's quick, it's easy, and you don't have to take time away from doing what you do on a daily basis to share with your office, with your constituents, that you are looking at every aspect to add value. So I really appreciate your time today. We thank you so much, and we would love to be of service to you. And I guess, Chase, if we can, if it's okay, if there's any questions that we might be able to answer, we'd love to be able to do that. And if we can't, we can certainly follow up with anyone at a later time so that we can answer them. But thank you so much for the opportunity today.
Yeah, Garrett, thank you for taking the time. Appreciate that. We did have one question come through that chat box. I know I got a few direct ones that I responded to as well.
Yeah, I just saw that. That's a great question. So you're right. A lot of entities look at this and they do this in Excel. Looking at the benchmarks and being able to see what your other peers are doing adds another layer to, are we doing everything that we can do? So in terms of the liquidity management, when we look at every transaction, we look at every debit, we look at every credit, we run it through a Monte Carlo simulation. We identify every opportunity from the time you take $1 in deposit to the time that you spend it. How long do you have it for? When we use all of the data from our clients across the country, we're able to bring more value and validate, are you doing the best that you can? And that really takes it to the next level. So you're right, a lot of entities, they're doing something similar to this internally, but when we can add our additional value of data points, it really makes it a more robust type of liquidity analysis for you. And in addition, if that's something that you don't do, we can do it for you. And if it's something that you do, but you'd like to spend time looking at it from a third-party perspective so that you can have a certified objective view, then we can do that too. But looking at our statistical modeling, it typically adds more robustness so that you're getting all of the value that you can beyond just a fancy Excel spreadsheet tool, as Henry, you mentioned. But great question.
And Henry, hopefully that does answer your question. You know, if there's additional follow-up, we're happy to field that and answer it further. Fantastic.
Yeah.
Great. Garrett, I did have a quick question before we, I know, in a few minutes here, we're going to sign off, but that RFP prep, is that something, that most of your clients who use CashVest also participate in? What's your frequency there?
Yeah, great question. So a lot of times our entities that we work with, they want our CashVest by 3+1, the liquidity monitoring, treasury services data. Sometimes when we provide that information on an ongoing basis, definitely we're not pushing banking services RFPs. If you're doing one or you're going to do one, we want to help you with it. But if you're not looking to do one, but you just want to check up and you want the CashVest services, you may find after reviewing the data, hey, it may be best if we can't work with our bank and negotiate a structure that works for us to issue an RFP. So sometimes we can work on your behalf to get you the results with your bank. Sometimes we don't need a banking RFP, but oftentimes it takes that to make sure that you can certify for your board or for your constituents that you did your due diligence, or you may bring yourself to that conclusion. You may say, listen, this really is something we have to do. We haven't done it in 5, 10, maybe more years. Work with one entity. They hadn't done a banking RFP in 40 years. They had worked with their current bank, the bank before that bought them, the bank before that. And they were surprised, even though they had a great relationship with their bank, and we wanted to do everything to preserve that, how much more they were able to get and how much that process actually led to having a more equitable banking relationship. I hope that answers your question, Chase.
That's great. Thank you. Great story there. Well, Garrett and Tyler, thank you for taking the time and presenting today. Attendees, thank you for joining us and taking time out of your day. I will be sending out these PowerPoint slides as well as a link to the video recording and your CPE credits. So expect that later in the week. And we'll go ahead and call it off right there. And any last words, gentlemen?
No, I would just say thank you again. Just a reminder, we don't manage money. We're not a bank. We're not an investment advisor. We don't compete in that area. We're just a data company that wants you to use all of your financial partners to their greatest capacity. So thank you so much. Really appreciate it.
Thank you, everyone.
Thank you both.
Thank you.
Thank you, Chase. Thanks, Garrett, Tyler. Really appreciate it.
Yeah, Kyle, thanks for joining us today. Talk to you all soon.